Good afternoon and a very warm welcome to all of you, and gratitude for being here on time and spending out your time for us. Let me begin by saying to all of you, very warm welcome to the Samco family. Yes, you all make it complete now. This journey was started as a dream by our founder Mr.Jimeet Modi in 2010, and brick by brick he built this organization to become one of the best asset management companies of India. With that dream, you all make us complete now. We started working on this space in 2016-17. We applied for the license in 2018. We got in principle approval in 2019. And in 2021, we got the final approval. You all know the challenges that we all have gone through together, but a dream and the passion of a man can make anything, come true, and that's the real example and the live example that we all have watched today. So today, without taking much time, I bring upon to you the entire investment committee of Samco AMC. I have today with me Jimeet Modi, founder and director Samco AMC. I have with me Umeshkumar Mehta, CEO of Samco AMC. Both the fund managers, Mrs. Nirali, Bhansali and Dhawal is also here. And we have Matalia, Head of Research for Samco AMC with me. So today being the historic day, this is our first ever unit holders meet, and thank you, and once again a very warm welcome to all of you. And without taking much time, I would like to call upon on desk Mr. Jimeet Modi, founder and director Samco AMC, to give you the opening remarks.
Good afternoon, everyone. At the outset, I would like to thank everyone who's come in person today for the purpose of attending our first unit holders meeting. Obviously, this is a very historic day for us, and the first of many more to come. For all those who have attended and taken your time, thank you very much. And for those who have not been able to attend, we will also obviously be putting up a video of the same on YouTube on our channel, so that other investors who are not able to see the proceedings of today's meeting are able to view the same on YouTube. Also, I think at Samco Flexi Cap Fund, what we would like to do is we would like to thank our 55,000 plus investors. So as of today, we are about 55,000 investors who are invested in the Samco Flexi Cap Fund as unit holders, and that is a very, very large number. So we are very happy of the fact that we have investors right from Jammu and Kashmir to all the way to Tamil Nadu, right from the west of the country to the east. So a very good spread of investors, and what that does is it obviously allows us to manage money a lot better than we could have otherwise, in case there are lesser number of investors or if there is lumpier money. So I think what is the purpose of today's meeting and why are we here? Fundamentally, what we would like to say is that at Samco Flexi Cap Fund, our belief is that at the end of the day, we are contractors of our unit holders' money. See, we are managing our unit holders' money so that we can create wealth in the best possible way for our unit holders. And the purpose of today's meeting is to help unit holders understand where has the money been invested, how we are investing, what are the stocks that have been invested in, what is our outlook on the market, so on and so forth. And at the end of the day, I think we will make this an annual affair for us to understand, we've set out a fantastic strategy that we know that works. Now, for us, it's important to keep periodically testing, keep periodically communicating, what we have done in order to execute the strategy, and keep reminding ourselves that this is the strategy, this is the 4 corners of the strategy, and we will continue to execute within the 4 corners of that strategy. So this meeting, so the unit holder meeting, and subsequently we'll also do quarterly calls to help communicate how we are consistently applying the strategy and executing the same. This is also a forum for us to have a two-way communication. So, for us with our unit holders. So, while we were sending out invitations for this unit holders meeting, we had also sent, a link where investors could submit their questions. So we've got questions, over 140 odd questions from our unit holders across the board. We've grouped those questions into certain key categories, and basis that we will be responding to those questions. So, further, a lot of you guys would also have been given cue cards as you entered today. So if you've got any questions, you can put your question on a cue card and then circulate it to any of our team members here, and who will help you to, who will help you communicate that question to us, and we'll respond to the same. So in any case, if at all there is any question that remains unresponded, please feel free to reach out to us even after this meeting, and we'll be happy to respond to the same. I think one thing that I would like to communicate is that our goal as a mutual fund and as at Samco Flexi Cap Fund has been very clear. Our goal is to be the best possible fund that we can be. And what do we mean by that? We mean that we want to try and generate the highest possible risk-adjusted return, over the long term for our investors. So let me break this down. When I say, we are not saying that we want highest return in any period of time. We want to make sure that we generate consistently high returns over a period of time on a risk-adjusted basis. So now why this is important is because we would not like to take an obscene amount of risk with our investors' money. And how do we ensure this typically? And Nirali and team will outline the strategy and how we've invested. But I would like to leave you with, one thought where there are typically, I think if you were to break down all returns get broken down into 2 broad categories. First, luck. Second is skill. See, returns can come by luck. There is a concept called beginner's luck as well, if you're aware. That you start out investing or you start out trading by yourself. If you have beginner's luck, you can end up making money purely because of luck. But the reality is that when you invest basis luck, or if that is a key contributing factor for your returns, it'll at some point of time there is good luck and then there will be bad luck. It gets cancelled out. The other bit or the other bucket, as I said, is skill. And what we are here to do is to identify companies that use skill, talent, and are able to consistently generate high returns for shareholders and investors, and invest in those companies. And which is why, as I said, we don't want to take obscene amount of risk. We don't want to put money in companies that get lucky from time to time and therefore are subject to cycles both upside and on the downside. Our job is to try and generate consistent risk-adjusted returns. And I think finally, as I close my closing remarks, my opening remarks, what I would like to state is that, see, we are 55,000 investors. We are a small mutual fund, and we intend to manage the money with the highest integrity possible. And for us to be able to, we would like to grow our investor base from 55,000 today to years ahead, to a much larger number in the years ahead. So my humble request to all those who are here, as well as those who are going to be watching online, is that if you believe in the strategy, if you believe that, we are executing the strategy the way we set out to be, please be our brand ambassadors. Please go out and tell your friends, your family members about the fact that you entrusted us with your money, and impose your faith in us, and we will do our best possible in order to make sure that we do our best to generate and create the best possible wealth that we can for you as investors. So that's it from me. Thank you so much.
Thank you, Jimeet. Next, I have to give you a welcome speech. We have Umeshkumar Mehta, who is the CEO of Samco AMC.
I take this opportunity to welcome our investors in the first unit holders meeting of Samco Flexi Cap Fund. I thank you for your overwhelming support to our first NFO. And with your support, we were able to garner 551 crores from 50,000 investors spread across length and breadth of India. And as on 31st March, our AUM is 622 crores and we have 55,000 investors. In this industry, a collection of this size for a new AMC is indeed record-breaking. And these are not my words. These are words from industry stalwarts. We have around 4 dozen AMC players and there are thousands of schemes for investor to choose from. Single most differentiating factor is return. Paisa kitna banega? How much return I will get? Carefully read the intention. How much I will get? Investor is not asking what's already earned. He is asking, he wants to know how much I will earn. But because future is uncertain, the alternative way that he or she has been answered is go back and check the past return, check the track record. This is what we have told the investors. This is old school of thought. A new school of thought is emerging. By the time investor purchases the set of current portfolio in a particular scheme, of course, after looking at the past performance, the portfolio itself might have changed substantially. Or for that matter, fund manager might have changed or the schemes might have got merged. So, when an investor invests today, basis the past performance, actually he is entering into a totally different portfolio, which on his basis, he thinks that this kind of return, this portfolio has generated. No, the portfolio that had generated the return since inception, last 5, 10, 20 years, that has substantially changed. To put it simply, the portfolio since inception might have changed substantially over the years by the time he invests, but he still checks return since inception. This is old school of thought. Looking at the rear view mirror. So now, the new school of thought caters to this latent need of investor to know paisa kitna banega that he or she will generate going forward. If you ask any smart person on the street, he will say returns are being made by the constituents of underlying portfolio of stocks. No fund house, big or small, no fund manager, known or unknown, generates return from their own pocket and puts in the scheme. It is a larger than life Mr. Market that generates the kind of return. Therefore, it is our endeavor to articulate our investment process, our investment identification process, so that you know, you enter into our shoes and then understand how we look at investments, what's our strategy, because going forward, the underlying portfolio is going to generate that kind of return and not the past. So now comes the next question. What is the return expectations? Paisa kitna banega? If you ask today's smart investor how much return he or she expects, obviously they are well read, social media savvy, they would reply, अरे भाई वॉरेन बफेट ने 55 साल में 20% 20% कैगर रिटर्न बनाया है. S&P 500 has generated on a like to like period 10.5%. आप मेरे को इतना रिटर्न ला के दो. And this is what Warren Buffett has done. Then we tone down the expectation of investor. अरे भाई 2-3% FD से ज्यादा मिला, खुश. मार्केट ने जितना रिटर्न जनरेट किया, बी सेटिस्फाइड. This is what we have told to our investors. But our answer to him is, we will try. We are aiming to meet investors' high expectations. What actually will happen, only time will decide, but let me assure you, we are committed to meet the need of today's investors' expectation of high returns. And in this regard, let me highlight few important steps that we have undertaken. You all know we had extensively communicated during our NFO campaign that we will be the first AMC to disclose active share. So now let me answer why. Why we took up that challenge. If we do same thing, what others are doing or majority are doing again and again, we cannot expect a different result. This is a general principle. Today, a good number of asset managers are leaned towards index hugging, and this is a global trend. Index copying, or in simple terms, maintain high components of index in a scheme portfolio. When my fund manager shows in her presentation few slides on look-through metrics, especially of the benchmark, it will be abundantly clear that what the fundamentals of the aggregate bunch of index companies are and what are the fundamentals of our portfolio of stocks. The difference is huge. Let me just refer to one number. ROCE, return on capital, which actually measures the efficiency of the company. This number for Nifty 500, is 16%, and for our flexi cap category, for our 25 stock portfolio stocks that we have, is 26%. And you all know, Charlie Munger has in his famous quote said, long-term return of a stock will converge towards return on capital. We are aiming for that. So now, here comes an important part. If we want to meet high expectation of investors, we have to build a portfolio widely different from index. Because if index or index plus is there, 16% is what they generate. And if we want to really meet the high expectation of investors, we need to curate, we need to build portfolio of one of the best companies for him or her. And only then we will be able to deliver that kind of outsized returns, irrespective are they, or those stocks are there in the index or not. I told you, we are trying to achieve those high expectations, and that can be achieved through creating a portfolio widely different from index. That is why we are showing active share. It is a byproduct of what we are doing in order to meet high expectation of investors. So now, let me touch upon one more angle, how we look at investments and our investment philosophy. See, everyone in industry, in order to be ahead of the competition, wants to score high on return scale. सब fund manager को अच्छा पैसा बनाना है. But in doing so, we don't want to lose sight of some of the principles laid in our scriptures and also expressed in Bhagavad Gita. Chapter 2, verse 54. Who is the ideal person? अच्छा इंसान कौन है? And the answer is Sthit Pragya, meaning one who is balanced, maintaining calm state of mind in good, in bad times. This is called steady wisdom. Now, as part of its nature, Mr. Market will sometimes become volatile, especially in short term. But why I as fund manager has to become volatile and start doing all sorts of derivative hedging, writing call? I have to maintain a calm and composed state of mind. Therefore, we at Samco, we will not lose sight of our long-term goals And this is the reason why we have not included as part of our investment mandate derivatives, hedging, etc., etc. In Gujarati ma, આપણે કહીએ હથપતિયું, lot of action, and this get captured in turnover of the scheme. We are therefore disclosing voluntary dealing cost, which is nothing but a byproduct of high turnover in the scheme. The steady wisdom or the sthit pragya calls for a saner view, a balanced view, rather than becoming volatile and start mirroring market and do all sorts of buying and selling and increase turnover. Market गुलाट मारे तो શું આપણે બી ગુલાટ મારવાની? ના મરાય. કોણ કેટલી ગુલાટ મારે એ વોલન્ટરી ડીલિંગ કોસ્ટમાં પકડાય. All disclosures that we are making as first time as an AMC that we are making is all with the understanding that we want to set high standards for ourselves so that we can meet high expectations of our investors. In meditation, there are many schools of thought. One such being Vipassana, which propounds for a happy state of mind, one needs to live in the present, the essence of happiness. Similarly, who is a happy investor? A happy investor, before investing money today, checks, is the company worthy for investment today? Are fundamentals great today? Does the company has a strong balance sheet today and not in future? We check all these through our hexagonal investment framework. Is the company worthy for investment today? Andaj, atkal, hopes, expectation is not safe for investing. Of the past few months, many IPOs, especially the startup IPOs, you all know, so many of the asset managers have bought in these high profile names, and you all know the results. We have not and will not invest our investors' money basis future dreams, stories, fads, fancies, but we will look at present day economics of the companies or the business that we invest and truly following the principles of living in the present. All these spiritual principles that we are following are made as a part of our process, and that we all know, our hexagonal investment framework, which my fund manager will again touch upon in her today's session. So, this is how we look at investments, how we analyze, how we see things, and more of which we will share in our future meetups. Before I call upon my fund manager, Mrs. Nirali Bhansali, to share the strategy and portfolio composition, I would like you to share our internal investment process. We five sitting here work as a mastermind group through IC Investment Committee, who we all have diverse backgrounds and qualifications. We have rank holder chartered accountants, MBAs, chartered financial analysts, engineer, and years of only equity market experience. And we work with single-minded goal, meet investors' high expectations. As a team, our collective decisions are far better than individual ones. Important and final message. We are here with single focus to create superior long-term wealth for our investors. We are here to nurture long-term relationships with our partners. We are not here with short-term horizon. We are committed to create long-term wealth for our investors. We are committed to build long-term relationships with our partners. And in this journey together, we all will create win-win situation for all our stakeholders. And that's our commitment. Once again, thank you for patient hearing. And I call upon Viraj again to take this back. Thank you.
Thank you, Umesh Bhai. And for more information, I'm going to call upon Mrs. Nirali Bhansali, who is very young, dynamic, energetic, but on top of it, very, very knowledgeable to take care of your and my money. And from our investment process, we'll like to hear from Mrs. Nirali Bhansali from your end.
So firstly, hello everyone. Thank you for coming here today and hoping all of you all are doing great. So let me directly jump into our agenda, which is talking about what we are trying to do here at Samco Mutual Fund, at Samco Flexi Cap Fund, what is our investment process all about, and basically the execution of our strategy. So nothing in mutual fund basically begins without a disclaimer. So this disclaimer applies to all of our slides. Now, before actually I jump into our Flexi Cap Fund and what is our investment process there, let me just very briefly take you through a quick recap of the investment philosophy and actually the investment process of Samco Mutual Fund. So as a fund house, what is our investment process all about? Samco Mutual Fund is a Hexashield tested mutual fund. Now, why do I say that? And what do we typically check for? So we check for businesses' ability to survive even during stressful situations. And secondly, we also try to look for their ability to earn an above average return on capital employed even during down cycles. Why is that? Typically, what has happened is in the last 15 years, 52% of Fortune 500 companies have disappeared. So it has become very, very important now to judge the average life expectancy of businesses, which was actually 75 years in 1955, that has fallen to 15 years now by 2015. So checking of survivability of businesses has become very, very important. Secondly, there is only one driver of long-term returns, like one significant driver. This is an 80-year-old chart of S&P 500. In this chart, you will see that irrespective you have put in money or bought a stock at the lowest PE multiple and exited at the highest PE multiple, even after that, the returns would have just contributed to a 20%. But the major chunk, 80% of returns, ye kahan se aate hai at the end of the day? So the 80% return comes with companies, with businesses basically, who do a lot of internal compounding of their earnings. And this is what EPS growth is all about. So EPS and internal churning and compounding of earnings, that only help businesses to grow forward. And we at Samco are targeting this 80% of the returns. How do we do that? So we have built a Hexashield framework. So there are 6 pillars that we have behind the Hexashield framework, wherein our companies undergo a lot of tests and checks basically. So we check them for reinvestment and growth. We check them for regulatory stress tests. We do corporate governance. We do competitive tests. We do cash flow, balance sheet tests. But at the end of it all, the heart of our Hexashield framework is nothing but reinvestment rate, high reinvestment rate, and high return on capital employed. What are we doing typically is passing 67,000 companies from across the globe through our Hexashield framework, and only 129 companies have cleared. So this 129 actually becomes our investment universe as Samco Mutual Fund. So basically, this was all about our investment process as a fund house. But now jumping on to the main part, which is Samco Flexi Cap Fund. And what is the strategy that we have here? So Samco Flexi Cap Fund follows an E3 strategy, which is investing in efficient Hexashield tested companies, buying them at an efficient price, and therefore maintaining a very efficient churn and cost structure. Jumping on to the first leg of our strategy, which is buying only efficient Hexashield tested companies. So now typically what is this definition of efficient that I'm talking about? As I already explained, we pass companies through this hexashield framework. We have a 129 stock universe that actually becomes, from that 129 universe, we try to pick, so we have actually picked 25 efficient hexashield tested stocks. But what is this efficient that I keep talking about? The definition of efficient. It is nothing but we look for businesses who have high return on capital employed. We make adjustments to it, and then we see if this is sustainable even going forward. What are these adjustments that we are typically doing? So basically, the businesses make investments in R&D, technology, discretionary marketing and advertising, and they are typically expensed in the P&L, which actually affects the bottom line. But these very line items, they help to build intangible value going forward, and they shouldn't be expensed immediately. They actually should be capitalized in the balance sheet. So these are the kind of adjustments we are making to the ROCE to judge the true adjusted return on capital employed of businesses, and that is how we check for efficiency. What other characteristics do these businesses show? So what are these other characteristics that make them so efficient? Basically, they are B2C kind of businesses which are direct to consumer. Then they have repeat purchases, so that ensures a lot of repeatability, stickability. Then these businesses basically have high pricing power, so they are price setters and not price followers. They have high growth and reinvestment, and they also have very, very strong intangible assets, something which you cannot easily copy, which you cannot touch and feel. So they have brands, they have those competitive advantages, they have very high distribution networks, they have patents, etc. So these are the kind of these are the characteristics which actually make them efficient. So now coming on to the robust 25 hexashield tested stocks that we have in our portfolio, and typically what are the long-term trends or themes that we are trying to play through these 25 stocks. So the first theme is that we are looking at playing the cloud and digital theme through these four players. So we have a TCS, Coforge, LTI, Microsoft. So TCS basically leading position in the global IT and IT-enabled services outsourcing segment. Very, very robust ROCE. It has also partnered with Microsoft in cloud, and Microsoft itself is the second largest player in cloud currently. It is also the largest software company in the world, #1 share of PC operating systems. So these are typically the large cap stocks that we have along with LTI, where we are playing the cloud and the digital theme. Coming on to a Coforge. Basically, Coforge is one of the fastest growing mid-cap IT players in the cloud and digital services space. And through basically all four of them, we are trying to ride the wave of cloud and digital. Coming on to the next theme that we are betting on, which is financialization of savings and the lending theme. And who better than the Bajaj twins? Basically, Bajaj Finance, largest and fastest growing retail asset financing NBFC. Even during the IL&FS crisis, what happens? While the other NBFCs had NPAs of over 1%, Bajaj could manage to keep it below 1%. Also, high loan growth of over 30%. Through Bajaj Finserv, we are actually playing the insurance theme, as well as Bajaj Finance definitely contributes a very large chunk to Bajaj Finserv. So both of these players actually lend to very, very different segments and industries. And coming to the gold loan business, we have a very strong player in the NBFC business, in NBFCs basically. The highest market share in gold loan is with Muthoot Finance currently. So gold loan, if you are actually pledging your jewelry with somebody, you would obviously want confidence in the company. You would basically, gold lending is entirely a business of trust. And who better than Muthoot, who already has a track record of 83 years. It is also a dominant player in the south of India. So therefore, we have exposure to gold lending via a Muthoot Finance. Another theme that we are betting on is under-penetration of insurance. And ICICI Lombard, it is currently the largest private sector non-life insurer in GDPI terms. Very, very under-penetrated space, 0.94% of India's GDP. Compared to that, the global penetration is currently 3.88%. So there is a long runway of growth and opportunity to capture here in the insurance theme basically. Then coming through long-term trends that we are playing in the healthcare and pharma space, we are not doing it with the generic drug makers. We are looking for very, very niche players. So Divi's Lab is a pure play API manufacturer. So we are playing the API theme basically through a Divi's Labs. It also has 6 of the top 10 big pharma players already as its partners in the CDMO business. Then coming to a JB Chem, basically JB Chem, it is the 3rd largest manufacturer of lozenges globally. So what is lozenges? It's the strepsils of cough or cough-sils that you use, for throat issues. So basically, we have JB Chemicals into the acute and chronic therapy space. Coming to a Novo Nordisk is present since, so basically, it was founded 99 years ago. So that's what its history is. And it's always been a player in the insulin business. And currently also, it is a world leader in insulin pens, over 50% market share in insulin pens. So every one of the 2 insulin pens that you use today is by Novo Nordisk. So that kind of a player with very high, over 60% ROCs we have in our portfolio. Coming to an IDEX Labs, it is an early entrant in the veterinary diagnostic space. Now, this is a very new industry that we are trying to capture, a theme that we are trying to play with an IDEX. It is a $232 billion addressable market. So there is tremendous opportunity going forward through IDEX Labs. Basically, coming to the next theme that we are trying to play here with our 25 stocks, we are betting on India's infra boom. And, typically everybody would play it with a steel, aluminum, a cement kind of player. But now those kind of commodities you would just buy once because you would have to construct a building or a bridge, etc. Any infrastructure, you would just go and purchase it once. Once it is constructed, you will not go back to the company. Whereas with these players, a Pidilite, Supreme and Asian Paints, we are looking for repeatability in businesses. So if every 5 years or every 10 years you want to paint your home, or you have some plumbing issues, you might need pipes, plastic pipes, you have waterproofing issues, you might go to a Pidilite or an Asian Paints. So basically with these 3 players, we are playing the building material player, and that ensures repeatability in businesses. Then we also are very bullish on the India consumption theme, and we are trying to play it with 3 various industries. So we have a consumer staple, we also have a consumer durable, and we are also playing it through QSR. Jubilant FoodWorks, India's largest food service company with a 70% market share in the pizza segment. So it is also basically we are trying to play here the long-term QSR theme in the rural as well as the urban areas. Coming to a Dabur, world's largest Ayurvedic and natural healthcare company, very, very strong player, so much brand equity and goodwill that it has created for itself, and a lot of runway for growth going forward as well. Coming to a Crompton Greaves is basically market leader in fans and domestic pumps already. It is also getting into a kitchen appliances kind of space. Again, a very strong player, and as demand rises, basically all 3 players will definitely enable compounding in returns, compounding in earnings, basically in their own business. Then the next bet is on the platform businesses, because they have very strong network effects and a very strong reach as well through these platform businesses. Coming to a CAMS, basically India's largest RTA, serving 70% of the mutual fund industry AUM currently. It is a pure play on the AMC story. Now, betting directly on a particular AMC would entail volatility, because at the end of the day, the AMC's performance is looked upon by its scheme's performance, which is also prone to market volatility. But irrespective of how it performs, they will always pay a fees to a player like a CAMS, who is their RTA. So we are basically playing the AMC story through CAMS, which is basically immune to market volatility. Coming to MasterCard, everybody would typically see it as a credit card company. But what people don't know, it is also the second global electronic payment infrastructure player. And it has already built a 2-way network effect for itself. So MasterCard, with 2.2 billion cards in the world, is also a very, very efficient play on the payment theme. Then coming to Alphabet and Meta, this is basically Google and Facebook. Nobody needs an introduction to these two names. Very, very strong Google search engine, 80% market share, and Meta, Facebook, basically the first mover advantage in the metaverse. So through these four players, we are typically betting on the platform businesses going forward. Now coming on to the next theme that we are playing here with, the theme is basically innovative and futuristic technologies. Now what is that? Basically robotics, 5G, autonomous vehicles, the driverless vehicles that we see. All those themes we are trying to play with an NVIDIA and an LTTS. Now, NVIDIA is basically itself, they themselves have identified a $1 trillion market opportunity in the gaming space, omniverse, automotive and chips and systems, the semiconductors shortages that you all keep hearing about nowadays. NVIDIA is a very strong player in that space as well. And coming to Intuit, Intuit is basically a SaaS platform, global leader in providing tax software platform solutions and advisory, and it has a total addressable market of $300 billion. So again, as small businesses grow, Intuit is definitely bound to experience strong growth, and we are betting on basically this player for, because it is also, this space is very underpenetrated. In this space, it's only 1 to 3% penetration till date. So therefore, this was all about our 25 efficient Hexashield tested businesses, and we feel that with these 25 stocks we will be able to play the futuristic themes, the emerging themes, and as you know, these industries continue to grow, the businesses continue to compound, we will also be able to compound returns and create wealth for our unit holders and our investors. Basically, now, how will you judge the vitality of our businesses compared to the benchmark, compared to our benchmark, which is Nifty 500? So, in a look-through matrix, if you see, judging them on return on capital employed, basically, what is return on capital employed? The 100 rupee that you invest, and if it returns 25 rupees, then basically 25 on 100 will become a 25% return on capital employed. What we are trying to say is that our adjusted return on capital employed is at a 32%. Compared to that, Nifty's is at 18%. So you can see the gap. Our businesses on a weighted average basis give a 32% adjusted return on capital employed. Compared to that, Nifty's is lower at an 18%. Even if you look at it on an ROIC perspective, on a 5-year average, ours is much higher at 23%, Nifty's is at 14%. Our gross margin again is very, very high. 5-year average is at 64%. Compared to that, Nifty's is at 44%. On the balance sheet side, looking at it from a debt to equity perspective, we are at 0.21. Compared to that, Nifty is very highly levered at 1.44. Even if you see our top line or a bottom line CAGR growth, you will see that we are higher at 14%, 18%. Compared to that, Nifty is at 10%, 15%. So therefore, what you get from this is that our businesses are fundamentally stronger in terms of quality. They are better businesses in compounding abilities as well compared to the benchmark. Looking at our financial stocks, as in the financial stocks that we have in our portfolio, our pre-tax return on equity on a weighted average basis is at 26%. Compared to that, Nifty's businesses is at 16%. Capital adequacy ratio is again much higher at 22%. Compared to that, Nifty's is at 18%. So you see definitely on a look-through matrix, our businesses are fundamentally stronger businesses and better businesses compared to the benchmark. We also have a very, very well diversified portfolio, be it a chemical, a semiconductor, a pharma, a financial space or insurance. We have presence in each and every industry. And even looking at it from a market cap perspective, you'll see that we have 69% to large caps, 13% to mid caps and 6.4% to small caps. So our market split is also very, very well diversified. So we are market cap agnostic as well. So this was basically all about the first leg of our strategy, which is investing in efficient Hexashield tested companies. Now coming on to the second leg of our strategy, which is trying to buy them at an efficient price. This is a quote by Charlie Munger, and what is he trying to say here is basically, even if you've bought a stock at a premium or a discount, what happens is, over the long term, your long-term returns will definitely move or deviate around the internal compounding of the business. So now, internal compounding of the business, what does that mean? It means that they will deviate around the ROCE of the business at the end of the day, irrespective of you buying it at a premium or you buying it at a discount. If you see our businesses, what is our valuation in terms of TTM PE, which is trailing 12 months PE. Ours is at 38 and Nifty's is at 30. So on an absolute basis, you might see that, okay, it is slightly expensive. But that is not the correct approach to see valuation. You should see it on a relative basis. On a relative basis, even if you look at it, our businesses so basically on a relative basis also, this price is justified. Why? Because as I told you, our businesses are definitely fundamentally stronger. So our ROCE on an adjusted basis was 32%, whereas Nifty's was at 18%. Our gross margin was higher at 66%, whereas Nifty's was at 44%. So our businesses are fundamentally better businesses compared to the benchmark, and the price is justified. However, having said that, the TTM again would not be the correct approach because there is a COVID impact that comes and it is in play here. So therefore, it is not the correct approach to look at valuations. If you see, this is an example where I am trying to show you why TTM is not correct. Pre-COVID, what happened was in Jubilant FoodWorks, its EPS was at around rupees 24 per share, whereas at that time its PE on a TTM basis was 77. Again, what happened after that was COVID hit, the earnings contracted. So EPS contracted by 58%. And EPS actually forms the denominator of the PE ratio. So when the denominator contracts, the PE shot up completely. So from 77, it rose up to 280. Now that number has again normalized. So the EPS has come down again, it has normalized again. So now its PE is again at a 78, which is at par as at pre-COVID levels. So therefore, looking at PE from a TTM perspective will not give a true picture. And in the markets, we always, seem to look at things from a rear view mirror perspective. But you are actually paying a price today for forward earnings, right? You are betting on things to grow going forward. So ideally, you should look at it from a forward EPS or a forward PE perspective. And then if you look at our businesses on that basis, you'll see that our PE is at 33. So that 38 has only in a very small manner compressed to a 33. And this price, as I told you, is justified because our businesses are fundamentally stronger, fundamentally better businesses. However, having said this, we do not look at it on a PE perspective. We see something called as adjusted free cash flow yield. Now, what is free cash flow yield? Basically, the 100 rupees you would have invested would generate a 25 rupee in cash. Now, even if you pay 10 times price to book, which is a 1000 rupee investment, typically on that your free cash flow yield would be 2.5%. We again make adjustments to it. As I already told you, the investments that these businesses make in R&D, technology, discretionary advertising and marketing, which help to build intangible value. We make those adjustments to find out the adjusted free cash flow yield of our businesses as well. And on an adjusted free cash flow yield, you'll see Samco Flexi Cap Fund's adjusted free cash flow yield is 2.9%, whereas Nifty 500 is at 3.18%. Now, this would seem counterintuitive, but try to understand this from a bond perspective. Now, there is a AAA rated bond. As you can see, AAA rated bond has a cost of capital of 6.8%. So, the yield is 6.8%. But as the quality of the bond reduces, from a AAA it becomes a C rated bond, what happens is the cost of capital increases. So, from a 6.8%, it has become 12.7%. And with calculation of adjusted free cash flow yield, or basically free cash flow yield, you should look at it from this perspective only, that when the quality is better, so our business's quality is better, so the yield is lower, as I told you. So therefore, our businesses is better, so the yield is at 2.9%. And this is basically why, because I keep telling you that our businesses are fundamentally stronger, and this price is therefore a justified price and an efficient price that we are trying to pay for our businesses. So this was all about the second leg of the strategy, which is trying to buy them at an efficient price. But as we have already bought efficient Hexashield tested companies, we have bought them at an efficient price. So our churn rate is very, very efficient, and our cost structure is also very efficient. As you see, in the past 2 months, what has happened is we have not made a single churn in our portfolio. We have only bought stocks, and therefore our voluntary dealing cost today is at 0. What is voluntary dealing cost? It is basically whenever fund houses buy or sell stocks, there are brokerage, STT, GST. So the dealing costs which get added, they actually don't get added to the TER, the expense ratio. They get directly deducted from the NAV of the fund. So these costs are very, very important to look at as investors, because a continuous churn will keep adding to these costs, and that will be deducted directly from the NAV of the fund, which would or could lead to underperformance, right? So therefore, what we are trying to say that in our 2 months that after Samco Flexi Cap Fund got launched, our brokerage fees have been at a very minimum of 0.14% of a total AUM of 622 crores. So it's hardly 86 lakhs. And that is also because we have not made a single churn in our portfolio, and we have only bought stocks. So therefore, this is all about our three-legged strategy, which is investing or buying only efficient Hexashield tested companies, buying them at an efficient price, and maintaining an efficient churn and cost structure. Now, people have asked us, how are we different than other flexi cap funds in terms of our active share or our liquidity. Now, coming to that, for all those basically who don't know what active share is, I'd like to briefly explain. So there is a portfolio and there is a benchmark. Now, if your portfolio is completely same as the benchmark in terms of constituents, in terms of weightages, then there is typically nothing active happening here, right? So your active share then becomes 0%. But if your portfolio is completely different than the benchmark, then there is definitely something active happening here, and therefore your active share becomes 100%. Why did this issue arise is basically most fund houses, in the name of active investing, they were copying the benchmark to 60 to 70% and then charging a very high 2% TER on it. So therefore that underperformance would come only if you're saying you're an active fund house, then copying the benchmark, then adding a very high TER or attracting a very high TER. It is bound to definitely cause underperformance. This is also a mathematical example which will show the same thing. Now so basically what as investors we should typically look out for is a higher active share. Why is that? Is now you see the top table. In the top table you will see that there is a fund A with a higher active share already, which is a 90% active share. What happens here is on the passive side 10%, which is a weightage, you would get an 8% return, which is a normal passive return. Over and above that, to reach a 10% gross return, the fund will have to make an alpha of 2.2%. Now, compared to that, you compare this to another fund house with a lower active share, with a 30% active share. Over here again, 70% is the passive weight, you get an 8% return. But to reach the same level of 10% gross return, this fund will have to take on more risks. Will have to have a consistent alpha of 6.7%. So now comparing it to 2.2%, you will see that 6.7% is definitely tougher to do consistently again and again. Compared to that, making a 2.2% alpha is definitely doable and manageable. So therefore, having a higher active share from the start is definitely beneficial. And Samco Flexi Cap Fund's active share today is at 90.13%. Why do we have a very high active share? If you see the top 10 constituents of our portfolio and compare it to the benchmark, you will see that there is only one common stock, which is TCS. And that also the weightages are very different in both our portfolio and the benchmark. That is definitely acting and helping us get a higher active share. Also in Nifty 500, the constituents, which is basically automobile, bank, metal mining, oil and gas, power, all these industries, all these stocks form over 30% in our benchmark. But they are not present in our portfolio. None of these stocks are present in our portfolio. Because of this, our active share is very, very high at 90.13%. Our investment strategy, what has happened is after our NFO markets underwent a correction, so this actually gave us a very good time to deploy over 98% of our NFO proceeds. So we have deployed 98% of our NFO proceeds, and we have maintained a very, very disciplined approach to our investment strategy. And going forward as well, we will definitely continue with the same discipline. This was basically all about our active share and our investment strategy. Coming to the liquidity of our portfolio, basically 95.5% of the portfolio can be liquidated in a single day. So we have a very, very highly liquid portfolio. Even in the average daily volume terms, if you see, we have no issue, and our impact costs are also very less because we have a very highly liquid portfolio. We also have a very diversified investor base who have invested in the scheme for the long run. If you see, we have over 54,000 investors who have invested in the scheme, and that has helped us maintain a very good granularity basically in our AUM. And thank you firstly all of you all also for helping us maintain this granularity in our AUM, and because of that only we have been able to deploy money very, very efficiently and very smartly. And going forward as well, this kind of a participation will be helpful because as you can actually already see that our portfolio is very liquid. Coming to the scalability point, there is no issue because of the way that we have designed our portfolio and our scheme. So we have a lot of headroom for incremental capital even going forward. Now coming to the elephant in the room, which is, the challenges that we have faced for global investments. So currently we have a 6.4% exposure to our AUM in foreign securities. But what happened was that as mutual fund houses, there was a $7 billion limit for the entire mutual fund industry to invest in foreign investments. But that was about to get breached. So therefore, there were limits on us, that there were restrictions on us to make fresh investments in foreign securities. And we didn't want to be underinvested. We didn't want to have, an underperformance in the scheme and cause any disadvantage to our investors. So we found the most suitable weights on the Indian side, and allocated over the 65% of our portfolio to Indian equities. So as I already told you, we are, till date, if you see, we are 90% invested on the Indian and foreign side together. And, whenever we have no clarity, to be honest, currently, that when RBI is going to raise these limits and allow us to invest in foreign securities. But whenever it does happen, we will rebalance the portfolio at an opportune time and, go back to our original strategy of being 65% on Indian side and 35% on foreign side. So this was basically all about our investment process, our investment philosophy, and what are we basically trying to do here at Samco Mutual Fund and Samco Flexi Cap Fund. And yeah, now let's get on with the Q&A.
Thank you, Nirali. We've got a lot of questions from all of you, and we are going to address most of it. And a few of you have also given a few questions while entering the registration desk. So we'll be taking up that also. So majority of you wanted to know our outlook on the markets, interest rates, inflation, and the geopolitical tension which is going on. So Jimeet, if you can just address that.
So I think, first of all, what we will be doing is we will be taking the questions that were submitted by unit holders at the time of, when we had sent them the questionnaire. So those set of questions we'll be taking first, and then, questions on the spot. Obviously, Viraj will address them later. So coming on to the outlook of the market itself, I think there are several aspects basis which we track and we look at from deciding, and what our view or outlook on the market is. The first is the war itself. So, if you are aware, in the past, since 24th of Feb, we have been seeing a war in Russia and Ukraine. And what we've tried to put here is a chart of the past century. Now, for the United States leading index. Now, you'll see that during the period of a war, you typically see either a correction or a sideways consolidation. However, on the completion or even before sometimes the completion of a war, there has been a massive bull market that has followed. So if at all, if we were to see this period of February to April now, the war is ongoing, it is a period of consolidation. So for all practical purposes, today, the Nifty is at 17,500, even in February, on the 4th of February, it was still about 17,500 odd. So it's remained flattish. And our sense is it's a good period of accumulation of equities, because usually, historically, a bull market has followed the war. So barring one war, which was in the 1970s, where there was an oil shock, it doesn't appear that, we are going to see that kind of an oil shock, because in fact, oil prices today are back to the pre-war prices from, a commodity inflation standpoint. So I don't think that's going to be a real concern. If you can go on to the next slide. One more concern and, one more question or one more thing that we'll typically be looking at is interest rate hikes. So interest rate hikes typically in the past have always been historically positive. So on the left side, you will see the past times when the Fed has hiked interest rates. That is the bottom chart on the left. And in the corresponding period, you'll see the S&P 500. So if you see the S&P 500, it has actually rallied in most of the times than we've seen Fed rate hikes. However, on the right side, what you will see, you'll see a green line, you'll see a blue line, and you'll see a black line and an orange line. Now, typically, whenever the Fed fund rate hikes have been gradual and slow, the markets have continued to rally. Barring the orange line where they've been flattish, so those are typically characterized by fast interest rate hike cycles. What do I mean by fast cycles is that typically if the Fed was to come and say, we are going to hike interest rates by 1%, 1.5%, 2%, and there's going to be a very, very fast tightening. In that case, we may see markets going sideways. At the moment, there has been enough and more evidence that has been put on record by the Fed that they also want to slow down inflation in a gradual manner. They want what is economically called as a soft landing and not a hard landing. So our sense is that in any case, we don't likely see a very, very large bear market or a correction because of the Fed hikes coming in. Next, please. One more thing, a lot has been written in the past few weeks about yield curve inversions. In fact, there was an article today in the Business Standard, about yield curve inversion. In fact, everybody today has become an economist saying that, oh, there is a yield curve inversion and therefore in 6 months or 12 months from now, we'll see a US recession. So the reality is that, I think there is not enough data available when we look at yield curves. For us to be able to have this as a reliable indicator, there should have been enough data, 30 plus. Statistically, they say you need to have at least 30 data points to be able to conclude that this can repeatably happen in the past. So I don't think we have enough. So we sort of make a lot out of these yield curve inversions. And the second thing is that whenever yield curve inversions in the past have led to recessions, it typically has required continuous persistent yield curve inversions for 90 days. Now, what is a yield curve inversion? Just to sort of take a step back, it basically means that when shorter term rates, interest rates go higher than longer term rates. So when the 2-year interest rate goes above the 10-year rate, there is typically a yield curve inversion. And that inversion is what sort of causes people to panic. Our sense is that we are tracking this metric very closely, and if we see persistency in this metric for over 80-90 days, then we can probably say that there could be a US recession in the next 12 to 18 months. But at this moment, in fact, as we speak, yesterday itself the yield curve was positive. So it is quite a noisy signal if you were to just look at it on a day-to-day basis. And I think the only thing that we are really worried about from a market standpoint is the unwinding of the Fed, or what is called as quantitative tightening. So quantitative tightening by the Fed, we've seen 2 cycles. One, there was a taper tantrum in 2012-13. At that point of time, the markets fell 18-20%. Even in 2017-18, when the Fed sort of tapered their balance sheet, again at that point also the S&P 500 fell 18%. So our sense is that obviously this is going to be something that the market is going to watch. However, since the past 2 times, since the market has already been prepared for the fact that quantitative tightening results in a decline, I think this time around the markets seem to be far more prepared than the last couple of times. So again, we will see the pace of this tightening. We will check if the Fed is tightening in a very, very accelerated manner. And if so, yes, we could see some decline or deeper correction in the market. So I think broadly, these are some of the indicators that investors could look at while tracking the direction of the markets. But generally, if you're a long-term investor, you've got a 4-5 year point of view, and that's what we have been saying. If you're invested in a Samco Flexi Cap Fund, you will take a 4-5 year point of view. And from a 4-5 year point of view, we typically see that such a time where the news is typically bad, where interest rates are being hiked, there is fear of a recession, there is a wall of worry to climb, there is an ongoing war, there is a pending fear of a World War III. Such time where typically bad news dominates the headlines, these have been the best times to invest. So I think that is consistent with our view, and we believe that is how investors should think about investing from the next 4-5 year point of view.
Thank you, Jimeet. Couple of questions were on the similar line. I'm just reading it because there is no name attached to it. Globally, inflation is on the higher side, and so is in India. So markets for 22-23 will be on the lesser growth side, and plus the Russia-Ukraine impact. So this is what has been already addressed by him. Also, he has addressed the question of US. What if US goes into the recession period, and what will happen to the international stock market? And so the next question we would like to take is how is our Samco Flexi Cap Fund different than most of the other funds? And Umesh bhai, if you can also address along with it, why don't we allow 150 rupees SIP? Yes, sir. On a daily basis.
So how our Samco Flexi Cap Fund is different? So we have a deep research done through our Exachill investment framework. Second, we are, as a strategy, we have growth strategy and not value. We believe in investing in high growth potential companies. And as Mrs. Nirali Bhansali had showed you the chart of 100 years of US market, wherein 80% of return that got generated in past 80 odd years was principally by growth companies. When companies were able to grow, reinvest and compound, reinvest in business. So those are the kind of that's how massive wealth got created, and we also believe that same we want to create for our investors, and therefore let's keep our focus, our strategy tilted towards growth. We are truly active fund, and our active share is high. What I had initially discussed in my opening remark, we have a strict 25 stock portfolio, right balance, not too over diversified, not too concentrated. Maintaining the right balance. And as I told you, chapter 2, verse 54, everything in balance. That's how we also have created that kind of number. Low volatility, low voluntary dealing cost. We are the first to disclose that. And same I had covered in my opening remark, that basically investors know that what kind of activity we are doing. Are we really more volatile with market volatility? We also become volatile, or we have our own strategy, focus on long term and not do really do all those dancing that market does in the short term. And lastly, equity dominated fund. As I told you, we don't have derivatives or all these exotic currency, because our focus is long term. Money can be made by holding great businesses, and we don't want to get that disrupted by doing all sort of activities. So that's the reason why. So these are broad, this is how broadly we differentiate ourselves, and actually this is very rare that you will get all this quality in one set of fund. Thank you.
And about SIP?
SIP. We will explore, but currently given, so this is a requirement that we have received. We will explore, but all depends on economics and unit metrics that we will have to explore, and then we will decide.
Yeah. So I think one, specifically on a question of 150s, at the moment, I think the minimum SIP that we accept in the fund is about 1,000 rupees. And that number was I think 500. Okay, yeah. So I think basically the way we look at it is that every time there is a transaction, every time there is a bank mandate, we incur a cost, and basis that cost, in order to at least cover the cost of servicing and maintaining that SIP, basis that the minimum number sort of has been designed. One more thing is that, see, today the industry average size of an SIP is about 4,000 rupees. And we are much lesser than that. We don't see a sense of even going below that and having a 100 rupee SIP. It doesn't make sense. The average is anyway 4,000 rupees. You can start it with a 500 or 1,000 rupee. Because if you go to 100, there is no stop. Somebody will say, do a 10 rupee SIP, on a daily basis. So, there is a minimum cap that you need to keep somewhere, a floor that you need to keep somewhere. And I think that's how we've sort of decided. Also, somebody has asked us to why not a weekly or a daily SIP. Again, our sense is that 99.9% of investors prefer to do an SIP once every month. The concept is like an EMI. You don't pay an EMI every day, right? You pay an EMI once a month. Once you get a salary, you take a part saving and put that in the fund for investing. So conceptually, 99.9% investors invest on a monthly SIP basis. So, as Umesh bhai said, we will evaluate and do this, but at the moment, it is not a part of our roadmap.
Thank you. The next question that we are addressing is, what's our strategy for foreign investment since the limit is exhausted for the industry? Are we using more of traps, or do we have any other strategy? Nirali, if you can address that.
Yeah. Thank you. So, as we have already maintained that we do not intend to hold cash, barring the redemption obligations that we have. If you would have noticed by now, we have already invested over 90% of our capital. So by Feb end, we were 45% invested. By March end, we are 90% invested, 83% in India, Indian stocks, and around 6.4% on the foreign side. And going forward as well, we want to deploy the funds in a similar manner. If in fact, if we would have held cash, what would have happened is the NAV as on 31st of March that you see is at 10.14, that would have been at 10.08. So there would have been an underperformance, which would actually have been a disadvantage to all the investors. So what we did was we found, as I already mentioned, we went on to the India side. So we found suitable candidates in Indian markets and have allocated funds for now. Going forward as well, we are definitely completely 90% deployed, and going for whatever ahead of that is incremental capital that keeps coming in. So we actually do not intend to hold cash. And going forward as well, we will deploy the capital as and when it keeps coming. Coming to the RBI scene, we have no clarity when it will open, but whenever it does, we will, and we intend to go back to our original strategy of putting 65% to Indian equities and 35% to foreign. So yeah, this I hope answers the question.
The next question is, why did we not invest in Nasdaq 100 ETF on the foreign restriction side, since the ETF investment was still allowed? Dhawal, if you can address that.
Yeah, thank you for the question. So yes, investments in foreign ETFs are allowed, though there are restrictions on foreign investments. But our mandate does not allow us to invest in foreign ETFs, so we did not invest in Nasdaq ETF 100 fund. Thank you.
The next question, Jimeet, if you can address and give us some brief on why the notice or the addendum which was been issued.
Hello, yeah. So, as Unitholders, you may have been aware that we had issued a notice and an addendum on the 9th of February. Now, that was essentially to comply with the regulatory requirement for incorporating certain aspects in the scheme. And there's quite a funny story there that, the regulator asked us to make certain amendments to the scheme information document. And whenever there is a change to the scheme information document, there is a notice and an addendum that has to be issued. And because we incorporated our entire hexashield strategy as a part of the SID, we also had to, it was presumed to be like an attribute change for which there was an exit option given. I think the funny story was that this was sort of blown out of proportion from a media point of view, but by certain people who were not too happy about the way we raised money and were successful as far as the fund was concerned. And with that in mind, it's a story, it's a compliance matter that we had done and completed, like is the case for most other AMCs when you issue a notice and an addendum. So I think that is history. I think the way we think about this episode is that dialogue from Guru, where Dhirubhai Ambani sort of portrayed saying that if people start talking about you, अगर लोग आपके बारे में बोलने लगे तो आप तरक्की कर रहे हो. So that's what our view on the entire issue is.
Thank you. We are going to take a stock-specific question on Jubilant Foodwork. What is the risk of the CEO exit? If Dhawal, you can address that.
Yeah. So if you just change the slide. So of course the stock came into a certain limelight when the current CEO Pratik Pota resigned. So it reminded me of a quote by Mark Twain where he said that history does not repeat itself, but it often rhymes. So if you go back to 2016 when the former CEO Ajay Kaul resigned, market gave a knee-jerk reaction and the stock fell by 10%. And a similar thing happened when Pratik Pota tendered his resignation in March 22. The stock again gave a knee-jerk reaction by falling close to around 10%. So we feel that the current fear in the stock price is, temporary and quite short-lived. And if you see in the past, Jubilant Foodworks has always onboarded quite strong and successful CEOs. And we think that this time it won't be any different too. Coming on to the fundamentals of the company, what gives us confidence in this inflationary environment on margins and profitability front is the amount of ad spends which Jubilant Foodworks does. So if you see, Jubilant Foodworks, their ad spends is close to 8% of their revenue. And, this gives us a confidence because if hypothetically speaking, if Jubilant Foodworks were to cut down or trim down their ad spends, the PBT, would surge close to around 200 crores. So, this gives us comfort. And even when we look at number of store counts of Jubilant versus other players, Jubilant Foodworks has outgrown both in terms of number of store and the growth of those stores. So now this has been possible because Jubilant Foodworks works on a one store, two business model setup. So here, the number of stores, the size of the stores are quite smaller because Jubilant Foodworks from the past has been, leveraging its own online delivery ecosystem and not relying too much on the Zomatos and the Swiggis of the world. And this has led Jubilant to deliver higher EBITDA per square feet on lower square feet per capital expenditure. If you go to the next slide, one more important point which adds to our confidence is that this is a latest investors presentation of Domino's Pizza Inc., which is the US entity of Domino's. So if we see that the India market is not only leading the emerging pack market, but is only close to the US where the store counts are close to around 6,500. And even Domino's Pizza Inc., the US entity expects that the Indian entity can grow or double their store size close to around 3,000 stores. So, this certainly gives us confidence on the growth prospects of the franchisee. Yeah, I hope this answers. Thank you.
Thank you, Dhawal. The next question is for Paras. Paras, if you can address why there are no banks in our portfolio and will there be an underperformance because of that?
Okay, hi. So optically, if you look at the portfolio, you will find that there are no banks or lending businesses. But what we've done is, we've taken exposures to these businesses via niche NBFC businesses who are best at what they do. So for lending businesses or financials, we have taken Bajaj Finance. For gold loans, we have taken Muthoot Finance. For cards and payment services, we have MasterCard. So the reason behind taking this approach is that, these businesses are very, very efficient, even on a fundamental basis. So if you look at all the key matrices, NIMs, NPAs, and the cost of funds, you'll find that these businesses are far, far better than a lot of banks out there. So coming to the technological spend as well, you'll see that these NBFCs are spending, for example, Bajaj Finance, the technological spend is growing at a 35% CAGR since many, many years. So these banks have these NBFCs have a very granular loan book, with small ticket sizes. So the chances of NPAs coming, a bigger NPAs coming is very, very less. As Nirali rightly pointed out that, even during the IL&FS crisis where a lot of, banks and NBFCs had to post large NPAs, Bajaj Finance's NPAs stayed below 1%. So coming to the question of underperformance, so if this index heavy banks actually go up or run up, then there could be a short-term underperformance of our portfolio. But we are fairly confident that in the long run, we'll be able to beat them. I hope that answers the question.
Thank you. For our next question, we have a similar question from one of the investors today over here also. So there is a question for Mr. Umesh Mehta. You said that you will be staying away from the recent IPOs. Will you be investing in the LIC IPO, and if not, will you be pressured to do so? So first, Dhawal, if you can just address whether we will be investing into the...
So this slide we also had. So we will not invest in LIC IPO. And Dhawal, you did research?
I'll take this. Yes, thank you. So, of course, it's a very hot topic, so let's take it. So, if you look at LIC, they have so the LIC's market share has been consistently declining. So, even on a new business premium perspective, LIC's market share was close to around 71% in 2017, and it has declined now to 66% in 2021. Even if one look at 13th month consistency ratio, LIC has the least 13-month consistency ratio, and this clearly depicts that LIC is facing challenges in retaining the existing customer itself. And talking about the profitability matrix of the company, the VNB margins are the least, which is 9.9% versus 20+% VNB margins of most of the private players. Now, this is majorly because of the hefty commission which LIC pays to its agent, because it has a vast agent network. So LIC pays close to around 5.5% commission vis-a-vis the 4.4% which is the industry median. So one more thing that I would like to add is that, since after listing, Government of India would be the majority shareholder of LIC. So what we think that the minority shareholder interest would not be quite aligned with the government interest of social welfare. So for now, we would like to stay away from LIC's IPO.
I think there was one more interesting question. If we would be pressured to...
Will you be pressured? So I was...
Pressured to put money in the LIC IPO. I think, we are already 92% invested. 90 as of March, and now we incrementally keep investing. Our sense is that by the time LIC IPO comes, we would have allocated 99%. So if somebody pressures us also, we'll tell them we have no money left. We've already invested in other names, so we're not going to sell something to buy LIC.
So this question came from Mr. Daniel Fernandez, if you're still here. I hope this answers your question, sir. So the next question is, what will be the impact of higher crude oil prices on Asian Paints? If Paras, you can address it.
Yeah. So all of us know that crude oil is a very, very volatile commodity. And recently it went up to $127 per barrel, and back in 2008 also it went up to about $147. So crude has always been up and down, and I think few months back it also went to $0 or negative price. So even after all this very, very high volatility, the gross margins, Viraj, can you please, yeah. So if you can see historically, the gross margin on a quarter-on-quarter basis have remained more or less same. a very, very high price hike in the crude oil, leads to some gross margin compression for few quarters. But in the long run, you can clearly see that, the gross margins on an average have stayed about at 40%. Can you take on the next slide? Even by looking at the price charts, it's very evident that even during 2008, when the crude oil reached all-time high of $147 per barrel, you'll see that even during that time, Asian Paints outperformed all other paints companies, all other companies, even though about 30 to 40% of its raw material costs are linked to crude oil. And again, in 2022, you can see that even though the crude price had gone sharply up, there was a small fall in the Asian Paints price, but it was still better than the competitors. And now, right now, it's again back to its pre-fall levels. So I hope that answers the question.
Thank you, Paras. The next question that we are again taking a stock-specific question on Facebook, recent correction, and how do we play this particular thing? If Dhawal, you can address it.
Yeah, sure. So if you just change the slide. So the reason why, Meta platform, which is formerly known as Facebook Inc., so it fell close to around 40%, and that was on account of management commentary where they said that we are transitioning from stories and feeds to reels, which is a shorter form of videos, and monetizing these reels would be at a very slower pace than, of course, vis-a-vis the stories and feeds. And if you look, and if you go back to 2018, a similar commentary was made by a Facebook management, where again stock corrected close to around 40%, where they said that the company is going through a transition from feeds to stories, and they said that stories would initially be monetized at a very slower rate. However, if you look at the fundamentals of Meta platforms, which is Facebook, we must say that Zuckerberg and team has quite been successful in transitioning from be it the web version of the Facebook to the mobile version or the mobile app version, and again from feeds to stories. And if we look at the CAGR return of revenue and PAT, the revenue has been in the last 5 years grown to close to around 35%, and PAT has grown to 45%, and I think that the transition was quite smooth. And also by changing its name from Facebook Inc. to Meta Platforms, the company has committed to be at the forefront of metaverse or AR or VR technologies, which are actually the future technologies of the world. And this gives us quite a confidence to remain and stay invested in Meta Platforms. Thank you.
Thank you, Dhawal. So the next question comes from Dr. DK. The surname is not clear. And sir, are you here? So I'll take up the question. Since it's been written by a doctor, I'm trying my best to understand the question. Whether the TER, what's the TER of the fund and how are you going to arrive at that particular thing? Jimeet, if you can address that.
So I think the TER as of March 31st is 2.45 or 48%. It is in the fact sheet. And the methodology of deriving the TER is pretty much statistical. The regulator, that is SEBI, they have a very clear circular on what is the slab-based TER that an AMC can charge. And we are charging pretty much accordingly in accordance with the circular that the SEBI states. And our sense is that, and if you look at the circular, the way the TER is designed is that 0 to 500 crores is 2.25% base TER, 500 to 750 it's 2%, then 750 to 2000 it's 1.75, and incrementally it keeps falling by 5 basis points. So as of now it is 2.45%, and also because there was an NFO, there are high initial expenses that are debited to the scheme. But I think in due course, the base TER of the scheme will keep reducing as the scheme size increases.
The next follow-up question, even I can answer, but if you want to add something, whether you and your family have also invested into Samco Mutual Fund, the answer is a very simple yes. If you want to add something, Jimeet.
I think the only thing that we will add is that as of today, and hopefully always in the future, the Samco group, the promoter, and associate group companies are the largest investors in the fund. So, we are larger than any other investor in the fund. So our money is fully along is invested fully along with the rest of the investors in the fund.
So the next question comes from Mehta, if you are here, sir. Samco Mutual Fund don't have any Play Store app, easy access, digital world investment and all process easy and convenient. Any vision on that? Umesh bhai, if you can address it.
Yeah.
It was meant for Umesh Mehta and not by Umesh Mehta.
So we are in the process of fine-tuning investors' experience on the website, and the moment we have done, we will also come out with investors' app so that it becomes easy on the go to invest. But yeah, it will take few more quarters, maybe 2-3 more quarters before we finally come out with a great app. But for the time being, we are fine-tuning our website experience, and I think we are verge of completing that.
So one final question from the audience today, from Mr. Sarthak Narkar, if you are here, sir. As we know that the future of automobile industry is in the EVs, have you thought about any EVs or auto stocks in which we will invest in future and try to, catch the trend? Nirali?
We are definitely taking exposure to EV. As I explained that the trend we are playing here is through NVIDIA and LTTS. So both these players are really strong players. They are already into the autonomy, as in the automotive space, and driverless cars, EV is everything that they are doing. So the ER&D play, which we typically call it, is definitely being played through NVIDIA and LTTS, and they are in fact early movers in the space where they are actually providing the chips that are needed to get these EVs running. They are helping it in terms of technologies, in terms of AI, as in AI, ML, and the future tech which is actually needed to have these sort of cars on the road. So we have exposure to an EV and automotives, driverless cars through NVIDIA and LTTS.
I would like to add something. The automotive space in entirety is on cusp of disruption with autonomous vehicles and EVs coming in the space. So the certainty with we can say with which players would actually come winners in the EV or autonomous space is very difficult. But the LTTS and NVIDIA exposure is such that even if one player or two players actually wins the space, these NVIDIA and LTTS companies will actually be the winner, no matter in the autonomous space who will win. So I hope that helps.
Thank you, guys. And final question to you, Jimeet, as to how do we trust a new fund house and put more money into it?
Yeah. So I think we often get this question, that because Samco, the fund itself or the scheme itself is new, how can we be trusted? And what we've typically done is that if you look at the 25 companies that Nirali has spoken about, the average age of these 25 companies is about 40 years. So while the fund itself may be new, the money where clients in money, the companies where clients' money has been invested is, these companies are almost on an average 40 years old. In fact, the oldest company is Novo Nordisk, which was founded in 1923. So it is almost a 99-year-old company becomes a 100-year-old company and has been one of the biggest and the fastest wealth creators in all time. So I think if you look at all the names, and as I said in my opening remarks, that we at the end of the day are contractors of investor money, right? And as contractors of investor money, we are essentially putting the investor money in these 25 names. And these 25 names have been around for a very, very long period of time. They have been trusted by the markets. They've been great wealth creators, and they continue to have, large moats around their businesses that can allow them to generate above average return on capital. So I think it is a sort of a pass-through trust where you have got to look at the fact that you are investing in companies which have a 40-year-old vintage and not just a fund or a scheme which is relatively new.
Thank you very much, guys, and this was it for today. I would like to end by extending my thanks. There is a very famous saying, हिंदी में बोलते हैं कि एक पान का पत्ता नहीं हिलता उसके मर्जी के बिना. So thank you God for allowing us to do this particular event and reach to this stage. And I would only like to end by saying that we have not reached so far to be so far. This is just the beginning at Samco Mutual Fund. You will see a lot of effort from our side, a lot of performance from our side, and a lot of hard work from my team. So thank you very much all of you for spending your time and being here today, physically also and mentally also, I hope. And thank you very much once again. And we would like to extend all of you with a very warm, very warm, I don't know at this moment what to tell you, but this is a dream come true for all of us when we are sitting in front of you and addressing the question. So this is it for the first unit holders meet, and we'll soon meet very soon. Thank you guys. Thank you everybody.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.